have you, Kirtan, once again. You joined one of previous spaces, but it is first dedicated spaces with you. Certainly look forward to learning so many nuances around mutual fund. Welcome to the firm.
Hey, thanks so much, Yara. I hope I can add value.
Surely you will add great value to our audience. So Ketan, so guys, Ketan, basically a CFP, and he is managing director at Credence Family Office, and he's also founder of FPA EdUtech. So more on his introduction, we would request Ketan to. So, Kirtan, please also tell us about how it all started for you. I mean, some family legacy in the financial market, or you are the first one in the family who started, and how it started for you.
Prince, I've just been lucky through and through. Very honestly, of course, I belong to a Gujarati family, so stock market, capital markets, everything was part and parcel of how we've been born and brought up. My dad was completely involved in investing in that sense, but no family history really with respect to what I am doing right now. So I was actually heading treasury for an NBFC listed on BSE, and that's where I bring my institutional money management experience. But while at that NBFC, I was called at various colleges to talk about fixed income macros and all of that, and I saw how unfortunately at the college level the knowledge was not that great, and I thought it was a good opportunity for me to really move out of my job and start something to do with education, because I saw a lot of potential given that I was invited to talk, and that's how the education side of the business started. And while we branched out, doing a lot of trainings around CFP, CFA, coaching a lot of mutual fund distributors and insurance agents, I thought there was again an opportunity to go back to what I was doing in terms of managing institutional money, to go ahead and manage retail money, and that's how the wealth side of the business started. So yeah, run two small businesses, one on the education side and one on the wealth side, Prince.
Great, great. So, Kirtan, how you manage your time? Because both the tasks which you say require a lot of time and attention. So, how you manage all that?
I think Prince. It's all about the team. I would rather say, while I may be the face, there is a very strong team at the back end who's actually managing most of these things. And largely, we've built systems in a way where there is an MIS reporting that happens, and that's largely what I really keep a track of. Day-to-day operations, I might not be completely involved. So I would rather say that while I represent here on this Twitter spaces as Kirtan Shah, but I think it's largely the team at the back end who puts in all the effort and gives me the opportunity to kind of take care of the branding, which largely is my job today.
Great, and kudos to your team as well. So Ketan, our today's topic is demystifying the mutual funds, separating myths from facts. So, I mean, I can understand your schedule because we have been planning this session since long, and this has materialized me at Diwali time. Anyways, so let's bring some festivity to our audience in the sense like they should be able to make a segregation that there are certain myths about mutual funds and what factual position is, because what I have observed by listening to people is they have a perception that you cannot make money through mutual funds, or it's a very slow way to make money, right? So I mean, over to you. Yeah.
Yeah, Prince, I think that's the biggest misconception that I would rather say that a lot of investors have. Disclaimer before I start, I have absolutely no liking or disliking from a business perspective towards any product, right? Because there is hardly any product that trades globally that we don't track and advise on. So for me, it does not matter whether it is direct equity, it is PMSs, mutual funds, whatever it is. We track, advise, give suggestions around all of these things. But having said that, I can tell you 95% of my personal money is invested in mutual funds, because it's the only product, at least the way I look at it, which is extremely transparent, extremely liquid, and the only product that can give you access to domestic equity, foreign equity, fixed income, gold, you name it, and there is an opportunity that you can explore, exploit using mutual fund, and at a throwaway cost, right? And such highly regulated. So I think the first thing that I really want to say is that it's definitely a big misconception that mutual fund is a product for selected few. I think mutual fund is a product for irrespective of whatever background that you come from. Even if you are a conservative investor, even if you are somebody who's starting off, or you are somebody who's an extremely sophisticated investor, and an ultra HNI or an HNI, mutual fund is a product for everybody. I don't see a reason why this limited thought around this. And if you see the difference, I think why a lot of people have this misconception that mutual fund may not help you make a lot of money is because unfortunately we keep hearing stories about particular stocks having generated x times the return in x number of years, right? And all of us really get attracted to those kind of stories without really understanding that most of us probably didn't know about it. It's only in the hindsight that we feel this is great. One. Second, even if we did know about it, did we really buy it? And third, even if we bought it, did we really hold it? I keep telling people that, you keep hearing stories about how had you bought Infosys during the IPO days and held on, then your 10,000 would have become 100 crore and all of those stories. My point is, how many people do you know of who would have bought it at 10,000 rupees and held beyond 1 lakh, 2 lakh, 5 lakhs? Hardly any, or probably nobody. Only people who actually forgotten about it have actually held on to it. So I think these stories are good from a motivation perspective to get people to invest in equities market. But I am very clear in my thought process that 9 out of 10 people who don't do investing full time will rather burn their hands by investing in direct equity portfolios versus an MF. So yeah, that's my thought.
And even Kirtan, like when people start, be it their starting jobs or their savings are limited, and it's always, uh, when it comes to investing in mutual fund via SIPs is definitely one way everybody can start with, however little their ticket size is.
Oh, of course. I mean, if your question, I don't know if that was a question or an answer, but I think that was an answer where you rightly said that even if there is somebody who's who's just starting off and is getting the first salary, right? For most of us, investing is not a full time job. It is something that we do along with what our full-time jobs are, and either most of us don't understand investing as much as we really need to manage it on our own, or probably we, even if we understand, we don't really have the time and the energies to do it. And that's where mutual fund as a product really comes in, right? Even if you are making 10,000 rupees a month as your first job, I think it's not difficult for you, if at all you intend to put 1,000 rupees and start an SIP. So definitely a brilliant starting point. And over a period of time, if at all you think that you've understood how investing works and you want to explore something outside, you can do that definitely over a period of time once you've gained knowledge and you are more confident and really have the time to be able to do it on your own.
So, Ketan, the biggest, what we say, hindrance or maybe the trouble which a person who is just starting faces is that what to invest, right? Because we are lured by the past returns rather than looking in the objectivity of which fund can do. Obviously, nobody knows how much, and when it comes to mutual fund, it is about optimum returns rather than the best returns, right? So how one can get going on that front? I mean, if
See, I think it's very honestly, it's futile to be able to talk about a discussion of what is going to work and what funds will do well. I think nobody has an answer to that question, very honestly. But so I keep telling this to people that even if I give you the list of 30 funds out of the 1,500 funds that are there today available to choose from, and I give you a list of 30 funds that I think are brilliant depending on whatever parameters that I've selected on, and I ask you to choose 5 out of those 30 brilliant funds that I've given you, I can still tell you that even if you choose those 5 out of the 30 that I've given you, the portfolio that you've built may not be great. So what I'm trying to tell you is that good schemes may not mean when you put 5 good schemes together, your portfolio is good. So what I really intend to communicate here is that it's actually not about the schemes or the past performance. It is actually about how you are bringing your portfolio together, right? So how are you deciding which 5 schemes go into your portfolio is more important than the schemes themselves. So to give you an example, what do I really mean? I really think that today most of us are not going to be in a position to be able to predict whether large cap will do well, mid cap will do well, or small cap will do well in the next 3 years. Or rather, most of us don't know, or I would say all of us don't know whether value style of investing, growth, or momentum will do well. Most of us don't know whether domestic equity will do well or international equity will do well. So if that's the case, and in my opinion that's the reality, then why try and predict and play something that is not your strength area? So what you ideally do is, if you have 100 rupees to invest, equally invest that across large, mid, small. Try and make sure that you, when you're trying to bring large, mid, small, all three of them together, you select schemes in a way where one of the schemes is doing value investing, one is doing growth, and another is doing momentum. I think if you are able to do just this much and put 4 5 schemes together, just keeping this thought in mind, you will be able to beat most sophisticated investors in the market. That's my thought.
That's the right. That's a wise way to go about it. So, Kirtan, often we see there is a debate going on between the direct and regular plans, and both the I mean, there are debates whether one should go by direct mutual funds or maybe through an advisor. So, what would be your take on both the side? How one can see it so as to understand? Because what the people do is straight away they will think that यार अभी MFD के through या किसी और के through जाएंगे तो there are charges and उसके interest aligned नहीं होंगे. That's a common perception.
Correct. So, Prince, I think investing is a mixture of science and math. What do I really mean by that is, science is to know why do you want to invest, uh, uh, how much do you want to invest, and math is to know where to invest that, right? There are two, or rather I would say three types of individuals that I typically come across in my journey of whatever little I do. One is somebody who knows everything and has all the time in the world to manage her money on her own. This set of individuals should definitely go ahead and be able to do everything that they want to do on their own, right? They don't need anybody's help because they understand investing and they really have the time also to go ahead and do things on their own. Second is somebody who has the knowledge but does not have the time, and third is somebody who does not have the knowledge, neither has the time. I think for the second category and the third category, in my opinion, both of these categories need help. If you have the knowledge but you don't have the time, or you don't have the knowledge or don't have the time both, you surely need help in terms of investing, and then wanting to do things on your own may not be fruitful in the longer term. So uh, the first category that I spoke to you of can definitely go ahead and do things on their own, and they definitely don't need any hand holding. But the other two category of people definitely needs hand holding, and I'll tell you why. Look, it's not about, and I keep telling this, that investment management is not about investment alone but behavioral management. uh, while uh, investing through direct may look cheaper, and it is cheaper. I mean, look may be an understatement. It is cheaper. uh, you have to ask yourself whether you are able to control your behavior. If you are able to control your behavior even during the best of the market volatility, I think you are prepared to go ahead and do direct. But if you don't have the time or the knowledge, or you can't control your behavior, then you are better off even spending that 50 basis point more going through an advisor, because whatever you are lacking as an individual, which is going to hamper your long term investment performance, is worth paying that 50 basis for. So that's the way I look at this.
So, Kirtan, let's keep the question from the point of view of a mutual fund advisor. So, what should be an ideal mutual fund advisor should be up to, and how he or she go about handling their clients? As you very rightly mentioned, that behavior is one aspect, understanding the goals of the client is another aspect. So, and any more sense on that before we go to Mahesh for his question? Yeah.
No, I think Prince, look, as somebody, and I don't want to talk about as an MFD, but I'm saying as an advisor. Let's say that advisor term can be used for a mutual fund distributor also, or a SEBI RIA also. That it's immaterial of who is this person that I'm talking about. But all I'm saying is that if there is an intermediary who's trying to help an individual, I think the first thing that you really have to understand is the background of the client that you are actually trying to invest for. So ideally what you should typically do is make a financial plan, make sure that you know the reasons or the goals for which the client is investing. You should know the history of how the client has invested. You should know the income expenses of the client today, and you should know the aspirations or the goals for which the client is investing. Because unless you don't know all of these things, it is impossible for you to be able to understand the risk profile that you really want to give to your client, or the asset allocation that you want to do for your clients, and hence you will always end up making mistakes. Selecting the right scheme or making a portfolio, in my opinion, is the last thing that you really want to do. Right, the first thing that you want to do is to make sure that the risk management is in place, and I keep telling this on all platforms that I go, that there is no point for you to keep doing SIPs for 5 years, 10 years, 15 years and not have a mediclaim. Because if you go the mediclaim way, or you rather are hospitalized, the 10 years of the savings that you've accumulated will all vanish in one day. So there is no point talking about schemes. Schemes are the last thing that you really should talk about. You have to make sure that you understand the financial goals of the client, you understand the risk profile of the client, you give the right asset allocation strategy to the client, make sure that the risk management is taken care of, make sure that the liability management is taken care of, make sure that the estate is taken care of, and then you spend time on getting the right schemes and the portfolio in place. I think that is what is expected out of the intermediary, in whatever terminology that you really want to use. Uh, that is what you expect that the intermediary does for the client, and not selecting the right scheme.
Right. And Kirtan, like be it individual doing themselves or maybe an advisor, as you rightly said. So tracking the performance of the fund manager or maybe trusting a fund manager, what all things you guys look for and what should be, the traits one should look for before investing in their funds.
I think, look, there are ideally three things that somebody like us looks at, but I'm not sure how relevant is it for an audience who's hearing us. Because, so the first thing that you really have to look at is the objective of the fund and whether the fund is following that objective or not. Now, I don't really want to comment on specific funds, but let's say, for example, if you are a large cap fund, right, and your objective is to invest in large cap companies, then you will have to keep a track on whether or not it is fruitful for your fund to invest in a loss making IPO or not. Now, is that the objectivity of the fund? Is that what the fund manager is expected to do? You understand whether you want to really invest in those kind of funds or not. So what is the objective of the fund, and whether the fund is actually investing as per the objectives or not? That's one. You also look at the sustainability of the fund manager, because irrespective, at least the way I look at it, when the AMCs come and tell you that we follow a process and it's not the person who's running the fund but the process that everybody follows, I don't really buy that argument. I think the person who really runs the fund brings in a lot of meat to eat in deciding how good or bad the fund does. So the longevity of the fund manager for me is extremely important. Third, very important, is you understand that funds follow a style, right? There are some funds who follow value style of investing. There are some who follow growth style of investing. There are some who follow momentum. Now, suddenly, when you see that there is a change in the fund manager, it is extremely important for you to understand that what the fund manager was doing in the past. Say, for example, if your fund follows a growth strategy, But when the fund manager changes and the new fund manager that comes in was doing value style of investing, you know that the past data is immaterial. It does not make sense to look at the past data at all, because everything that this fund is going to do now on is going to be completely different. Or for that matter, let's say when the fund manager changes, the new fund manager who comes on board is was managing a completely different market cap, right? So the new fund manager that comes on board was a small cap investor, but the fund that now he's representing is a large cap investor. You know, this is not what you were really looking at. So I think while there are a lot of technical aspects that you look at in terms of risk adjusted returns and various other things, what are the sectors in which the fund is investing and all of that, I think the most important thing is the objective of the fund. Understand the objective of the fund, understand the style of investing, understand what the fund manager thought process is, and just keep tracking whether the fund is actually following it or not. Right, the day you understand that the fund is not following, you know you want to exit. Because look, when you look at performances are cyclical, right? You will have sometimes that the fund will beat the index, sometimes that the fund will not beat the index. But if the objectivity is in place over the long term, you know that the fund will be able to do decently well. So you don't want to get stuck in a fund which looks A to you but is actually B in the real sense. So I think that's the main thing that you should really look at while you are trying to onboard or exit a particular scheme, Prince.
Right, Ketan. Let's take questions from our speakers. So Mahesh, you can unmute and ask your question. Mahesh, you there? And the other person is Rishikesh or Rush. I mean, sorry, I didn't get the name. Mr. Fulari, you can unmute and ask your question. Ketan, am I audible to you?
Yeah, you are. You're
Okay,
loud and clear.
okay, great. So Giri, you can unmute and ask your question. Otherwise, I'll go with my questions. Not sure what's happening with Mahesh or Giri. Giri,
Yeah,
okay, Giri is
yeah,
speaking.
I can go. You're able to hear me, right?
Yes.
Okay.
Loud and clear.
Yeah, okay. Hey, great session. Okay, good understanding. Okay, couple of questions. You strike the valid point. Okay, you'll have to understand the characteristic of the fund manager and stuff. Okay, so when it comes to a listed company, right? We get to hear in the earnings call how the promoter talks. We get to question them. So in this case, how do we profile a fund manager? Is there a platform that we can go read his history, or like we get to talk to him like as an investor?
See, very honestly, you will only be able to talk to him as an investor when you catch hold of them in some event. And otherwise, unless you are a big investor, and sorry, I talk black and white and I'm not gray, so
Mhm,
pardon my straightforwardness. But I'm saying you only get to talk to these guys if you catch hold of them at some event, or probably if you are a large investor and they know that they have to give you the time. Because look, there are thousands and lakhs of investors that they manage. They can't open the floor up for everybody, right? And there are not all of these AMCs who do AGMs where you can go and talk to them like a PPFAS does. So ideally, the way you really want to understand them is read the fact sheet, right? So fact sheet is the easiest way I can tell you, because every time you read the fact sheet, you have the fund manager commentary where they tell you what they believe is the way markets are aligned, and you see if they are actually doing something like that on ground on their funds. One. Second is a lot of these guys come on to a lot of television shows. Now, of course, that is largely filtered, but of course, you can hear them and build a perception about them whether or not what they are talking really makes sense or not. Because there is not a lot of opportunity for you as a retail investor to be able to directly talk to them unless you are a large investor or you catch hold of them on some platforms. The only way you really will be able to track to them is over a period of time, understanding what the fund is saying versus what the fund is delivering. So I'm not sure if I've been able to answer your question absolutely straightforward. Giri, or not, because there is no answer that I really have to your question. But you will have to keep tracking the fund managers when they write by themselves for the AMC, when they get quoted in media, or when they appear in television, because that's the only way you will be able to keep a track outside of what the fact sheet talks about them.
Got it. This is exactly, the same confusion I had. Like, got it. Okay. Yeah, yeah. And I mean, another question, which again you touched upon, is that okay? I know you have a way to curate these funds. Okay.
Yeah.
I mean, it's been even a meme or a joke in many of the WhatsApp thing. Okay. A big IPO hits the market. Okay. So these mutual funds are acting like exit for the PE funds. Okay. It's very painful to see them. A fund that you're invested in, is doing this job. Great names are doing this thing. So in that case, do you say that okay, close this fund and move on? If this is going to be the character, then I think it's time for you to exit. Because as an individual, I would never go touch that stock. But it's evidently visible. These fund managers are giving exit to the PE fund. Okay, so what do we do?
So, Giri, I think that's a very tough question for me to answer, but I am always straightforward. I'm going to give you a very simple suggestion. There are close to 1500 plus schemes available today at the time that you and I are talking. Okay. So,
Okay,
the easiest way to play this game is eradication. What I mean by that is, instead of finding which are the 5 schemes that I really want to invest in, because it's going to be a very, very, very tough call for you to be able to figure out which 5 schemes do I invest in out of 1500. The easier one is to eradicate. Eradicate means that you figure out that there is something wrong that is happening and you are not comfortable with, and decide that at least this is something that I really don't want to invest in. So play the removal game. Whatever is left behind is something that is easy for you to invest.
got it. Noted. Okay, got it. That helps. Okay, so kind of you.
Yeah.
Thank you.
Pleasure.
Thank you, Giri. So, Deepak,
Yeah.
you
Yeah.
can go next. Yeah.
Hi, good evening, guys. I have one question. So we are aware that we need to keep the funds. I mean, we need to keep invested in the funds for 5 to 6 years to actually understand the returns that it would be providing. But we are also aware that we need to keep rebalancing the funds, right? What would be the right time to exit? How do we identify that?
Uh, Deepak, if I get your name correct, yeah.
Yes.
Deepak, very honestly, I think you will have to understand a little bit more to be able to do that, and not assume that doing that is easy. And I'll tell you what do I mean, right? Please understand that markets follow cycles. Now, what do I mean? Let's say if I talk about equities,
Yeah.
right? When markets are expensive and you want to invest 100 rupees, then
Yeah.
you will understand that in expensive markets, value style of investing does well. And which is why you see whenever markets are expensive, funds like an ICICI or an HDFC, which follow value style of investing, will suddenly start doing very well, right? Uh, Inversely, when markets are cheap, right, when the valuations are cheap, you will typically see the likes of Axis and all of those who follow growth style of investing, they will suddenly start doing well, right? So why am I explaining this to you is for you to understand that just because the last 2 years 3 years of returns of a particular scheme has been good or
Yeah.
bad, there is no
Right.
judgment for you to make that the scheme is good or bad, because it might so happen that in the last 3 years value style of investing has worked, and your fund that you are evaluating was following growth style, and hence it's underperformed. It's natural for the scheme to underperform because it does not follow the style that has worked. Similarly, you look at the last 1 year and you will know that mid caps, small caps have done very well, but large caps have not done well.
Yes.
So do you go back? Do you go back and say that your large caps funds are bad and you should exit? The answer is no. So to answer your question, there are two things that you have to understand. And if you've been a part of the discussion since the start, you will relate to what I'm saying. Try and make sure that you have large, mid, small, if all three in your portfolio. Try and make sure that you have a good balance of value and growth, both in your portfolio. If you are
Okay.
able to do this, some part of your portfolio will always do well, irrespective of the business cycle. One. Second, after having done this, how do you decide whether you want to exit a particular scheme or not? I think there are red flags that you will have to understand. Some are
Okay.
technical, some are objective. Like say for example, what is technical? Technical is understanding that the CBLO of the fund was minus 17% 1 month before Franklin schemes went bust. That's technical. Now, if I go technical, most people will not understand what am I talking. So you, as a retail investor, you have to be slightly more objective. Objective that fund manager has changed. Do I need to worry? So what do you do is very simple. You look at who is and what were she was managing in the past, and you will understand. Like I was telling before, I answered the question that if there is a scheme for which a fund manager is getting replaced and the new fund manager who's coming in a small cap fund manager, then you know you are probably not comfortable in that situation, right? So you will largely have to understand that has the scheme changed from a flexi cap to a multi cap? Am I comfortable? If the fund manager has changed,
Okay.
am I comfortable with the background of the fund manager? Those are the nuances that you will look at as a retail investor to decide whether
Kirtan,
you really want to.
Kirtan, I guess your voice was breaking somewhere in between.
I'm not sure.
Yeah, only
What
little
is
Hello.
bit,
my
but it
healthy
was
voice?
understandable.
Okay, awesome.
Okay.
Deepak, my answer had to.
Yeah, got it. Thank you. Thank you.
Pleasure.
Thanks, Deepak. So, Kirtan, the same question is debated in direct stock investing also. So, do you think buy and hold works in mutual fund as well? Because we see there are people who talk about generating alpha through mutual fund also, like as you were talking about these cycles, right? So they were like they broadly gauge
Yeah.
the market, and on basis that they invest in large cap, small mid, and kind of generate alpha. So which way is your understanding on this thing? The buy and hold thing basically.
Look, very honestly, I'm very great proponent of hold. Uh, I say this,
Kirtan, I
but
would
that may not
request you to.
everybody, and
Yeah,
hence,
Kirtan, can you please drop once and join again, because the voice is breaking. I guess it might improve once you drop and join.
okay, I will.
Please, please.
I think it's to do with the Wi-Fi. Tell me if
Yeah,
it is
it's much
okay
better
now.
now. It's much better. Yeah.
Yeah. So to answer your question, I'm saying that look, that differs from person to person and who you are as an individual. What I mean by that is, let's say for me, I believe that probably I understand and have the technical skills, so I may be able to get in, get out at the times that I think appropriate. But does this is this applicable to the larger set of audience? My answer will be no, right? But you will have to define your uh, own lines with respect to what are you comfortable and what are you not comfortable with, because like I said, the biggest data point that you have to understand as an individual is why has the underperformance happened, right? Because you will only exit from a particular scheme because the scheme has underperformed. Now if I ask you a question, why has the underperformance happened, and if you are able to answer to that question, then you are in a position to exit or enter. But if you think that the underperformance has happened and so I should exit, then you are taking the wrong call. Because like I was just explaining, and all of those answers will boil down to probably the same thing that I'm saying again, that if the underperformance has happened because the style was not favorable, then you shouldn't exit, because that's the whole point of having a diversified portfolio, right? So for you to be able to understand why the underperformance happened and appreciate that, will decide whether you hold or not. So to make it simple, let's say in the last 1 year large caps have not worked. So does that mean that if large caps have not worked you should exit? The answer is no, right? So you will have to be in a position to understand why the underperformance has happened and how significantly important that data point is. Only then you will be able to understand whether or not you should take the underperformance seriously or not, because you will always have funds which will do well and always have funds which will not do well over a period of time. 10 years back, had you asked anybody this question, they would have said invest in Aditya Birla funds. 7 years back, had you asked this question to anybody, everybody would have told you invest in Motilal Oswal. 3 years back or 4 years back, everybody was investing in Axis and Mirai. And today, everybody is investing in Quant. Right? So these schemes will keep changing. You have to understand why and what part of the underperformance is acceptable and not acceptable. Only then you will be able to decide when to exit. If you are not able to do that, you are better off holding it than switching funds, because there is an exit load, there is a tax, and you will always, in the fight to chase the right fund, always end up losing.
Fair point, Kirtan. So we got few more speakers. Let's go to them. Giri, I'll come to that. Come to you. Before that, I allow Sujit. Sujit Kurur, right? Yeah, Sujit, you can unmute and ask your question, please.
Yeah. Actually, I want to know whether these index funds are better than other mutual funds or not. Hello, am I audible?
Yes, yes. So Kirtan, got a
I want to
question?
know whether the index fund is better than the normal mutual fund.
No, I could not hear him. Sorry.
So he's asking, why? I mean, he's asking why. I mean, index fund is better than mutual funds or not? Is that what you were asking, Sujit?
Yeah, correct.
So basically, Kirtan, his question is more around like active versus passive. Rather, you can, I mean, elaborate on that.
Sure. I have not. I could not hear him for some reason. But look, I am of an opinion that in the large cap space, index investing definitely will work, because post 2018, SEBI has made sure that there is not a lot of flexibility which is given to fund managers in terms of what they can really do within the large cap space. Right? They have to invest 80% of their money in large cap and 20% is available for them to invest elsewhere. And you will see since 2018, most of these large cap funds have not been able to do anything significantly different or better versus the index. So in the large cap space, I think there are two options that you have. One is stick with the index, but if you are an aggressive investor and you are looking at beating the index, then you can invest in flexi cap funds to large cap positions. Because largely, if you see, while the name is flexi cap and the gyan around it is that it gives fund manager the flexibility to invest across market caps, 90% of the funds in this industry are pseudo large caps. So what was large cap before 2018 is now flexi cap. So when you want to invest in large cap, you either invest through index or you invest through flexi cap funds. But I'm very clear in my thought process that in mid cap and small cap, there is a huge opportunity for you to be able to beat the index and significantly. And hence, I think in the mid and the small space, I would still prefer doing active versus passive. I hope that answers.
It does, Kirtan. Thanks. So Giri, you have another question or?
Yeah, I'll shoot my question. Yeah. You're able to hear me, right?
Yeah,
Okay,
please
yeah.
go ahead.
Like, Kirtan, if you can throw some light on, from a taxation perspective, let's assume that, I'm trying to look for a fund actually which would give me like, 25% return.
Yeah, I
Okay.
don't know why I'm not able to hear them asking the question.
Really? Okay. Prince, you want?
So Giri, Kirtan, am I audible, right?
Yeah, you are audible, but I'm not able to hear the others ask question.
That's let me hear out Giri and I'll pass on the question.
Okay,
That's what
I'll make it simple. Prince, from a taxation perspective, right? Okay,
right.
is there a difference in investing in a mutual fund on AAF and a direct investment? Okay, what benefits we get in from a pure taxation perspective? Let's assume in all three modes you get 25% annualized return. Okay, so from a taxation perspective, what advantage you get? Is there anything? Is there anything there or not?
So between active and passive, right?
Yes.
So Kirtan, the question is around like he's asking from taxation point of view the difference between active and passive investing broadly.
Very honestly, there is no difference at all in that context, is because uh, index funds will also remove some stocks and add some stocks, and active funds will also remove some stocks and add some stocks. It's not like a PMS that every time they buy and sell, it impacts you. Taxation in funds only impact when you exit, right? So you bought at 10 rupee of NAV and you exited at 12 rupees of NAV. In either case, active or passive, you end up paying 15% tax if you have less than 1 year of investment horizon, and 10% if you have more than that. There is no difference in that context in either of these cases.
Got it. Thank you.
Sorry, is there a separate or specific setting? Why am I not able to hear other stock except you,
Not
Prince?
not sure, Keithan, what's happening. Maybe some Twitter glitch here. I mean, these guys can drop and maybe try joining again in case they have any question. So Keithan, the question, there is a perception that people say if the AUM size is bigger, or if the AUM size is much smaller, that should be avoided. So it should be like the mid-sized or maybe a growing AUM size is preferable in mutual fund investing. So do you buy this statement, or this doesn't
See,
make any?
I can actually give you arguments on both the sides, right? You look at so so the general contextual understanding is that in the large cap or the flexi cap space, it does not matter what the AUM is, because companies that these funds buy are large and there is a lot of liquidity, and hence exiting these funds will not be a problem. And the general understanding is that in the mid and the small space, you have to be very cognizant of the fact that what the AUM is, because that space is illiquid, and hence funds will face a problem if the AUM grows, right? So largely I'm in sync with this thought process, but the data does not prove this, because you look at Nippon Small Cap, which is probably the largest small cap fund today, and it is in the best performing funds throughout for the last as many number of years that you know of, right? So I'm saying that yes, you should contextualize and look at AUM very significantly, but only judging the fund basis the AUM may not be the right way. So I would rather say that while you're looking at the fund, the objective of the fund is good, the fund manager has stuck around well, the portfolio looks decent, the sectors in which that they invest looks decent, everything is good, then I think you can then in that case slightly ignore even if the fund has a higher AUM. But if most of these other things don't pair well and still the AUM is higher, then you might consider not looking at the fund because the fund has a higher AUM. So what I'm trying to say is only looking at the fund's AUM and making a judgment whether do you really want to invest in this fund or not may not be the right strategy.
So Keithan, let's talk on the expectations front. So what do you think should be what in your view is reasonable expectations in mutual fund investing, be it active or passive?
I think large cap 11-12%, mid cap 13-14%, small cap 15-16%, and a mix of large, mid, small, which is ideally my strategy. You should expect 13-14%. That's a fair expectation to have. But also, what is extremely important to be understood is that if you look at cycles of these market caps, you will understand that large cap needs a minimum of 3 years, mid cap needs a minimum of 5 years, and small cap needs a minimum of 8 years. So uh, context is you might expect 14, 15, 16% from a small cap, but the idea is for you to stay invested for at least 8 years. You might expect 13, 14% from a mid cap, but the idea is to stay invested at least for 5 years. So look at the expectation in context of the minimum investment horizon.
So broadly, like the portfolio level return in the range of 13 to 15% is what reasonable expectation is, and anything above that, if you get, is good for you, right?
Oh, that also I am saying that if you have a good mix of large, mid, small, all three. If you invest 100% of your money in large cap and expecting 15%, that's a clear mismatch.
Right, fair enough, fair enough. So, Ketan, what would be your advice on the theme-based fund? So, you buy those in the sense like you recommend those, or they have a different set of clientele, or maybe who can invest in them?
See, the problem with most thematic sectorial funds is you will need to time your exit well, because all of these sectors are, like I'm saying since the start, cyclical. You would see 2 3 years they performing and then going down. Now who knew 18 months back that PSUs will work like the way they worked, right? Or before that chemicals or auto, or who knew that IT will fall as much as it has fallen, or pharma is at a far better valuation. So I'm saying that whenever you are doing thematic or sectorial investing, you definitely need a professional advice, because if you don't exit your thematic or sector funds on time, you will definitely be disappointed even if you stay invested for a longer term, because till the time the cycle comes back and the cycle matures, you probably would have stayed invested for 4 or 5 years and still not made monies. I mean, there are people who have invested in the infrastructure boom since the 2008 and still have they not been able to beat the market in spite of having a longer investment horizon. So the point is that when you do thematic investing or sectorial investing, you're exiting the fund is extremely crucial. You will not be able to supplement it by just staying invested for some more time. So you definitely need expert opinion while you are trying to play the thematic theme. Is what my clear understanding is.
Fair enough. And we respect your advice, Kirtan. But one question from our audience is like he's asking, would it be wise on his part so as to, like, if his time horizon is 8 plus years and at least for 8 years he'll be investing. So investing everything in small cap would be a wise thing for him, or you will definitely recommend him to diversify. I mean, how one can go about it.
See, that's a very interesting question, and I'll tell you why. Because when you look at data points, you will always understand that, or theoretically, you will feel that small caps will give you higher returns than the mid cap. I think the answer to this question is, when are you going to exit? Your exit will determine whether or not your 100% small cap portfolio made more sense, or a mid cap plus small cap portfolio would have made sense, or a large mid small. And I'll give you an example. Let's say in 2018, you have seen that small caps fell 20% plus in 2018, and that was the same time where large cap were positive 7%. Now please understand, at the time of your exit, right, what performance that particular category has done in the near term has a lot of importance. Imagine you doing SIP for 10 years, 20 years, 30 years, but at the time of exiting the market is down 20%. Please understand that your entire portfolio that you've accumulated over 30 years is down 20%, and not just what you've invested in the last 1 year. So while you are doing specific market cap investing, right, your exit is extremely important, because you want to exit at the high of the cycle and not at the low. So again, I would say, like in thematic, if you're going to depend only on one market cap to invest, your exit is extremely important, which may not be as important when you are well diversified across large, mid, small.
And Ketan, so business cycle fund is likewise a thematic fund kind of thing, or I mean, pardon my ignorance on that. Would you like to talk about it?
I think very honestly, business cycle funds are just another way for AMCs to gather more AUM. They solve no purpose, because at the end of the day, while you are investing in a large cap, mid cap, small cap kind of funds, the same fund manager understands what business cycles are, and hence, as per that business cycles, they move the sectorial allocations, right? So today, if you see, most funds are extremely underweight IT, is because they probably feel that the business cycle is not favorable, right? So there is nothing different that the business cycle fund is independently doing that a well diversified fund does not do. I think it's just another way for the AMCs to gather AUM.
Thank you. So, Shefali, you can unmute and ask your question. Shefali, you are on mute. And Kirtan, just like we have perception for IPOs that most of the IPOs are not retail investor friendly. So, is it same? Can we take an analogy for the NFOs in mutual funds, or we have to see that with a different angle?
No, they are completely different, I would say, because while you are talking about NFOs, there is no valuation angle, right? There is nothing that somebody is trying to exit. Like making a mention, or somebody else as a speaker was making a mention of how the mutual funds are giving exit to the latest IPO that came across in terms of VCs who invested earlier. So while you're talking about IPOs, whether or not you really want to invest in the IPO or not, the decision completely depends on the future earnings of the company, at what valuation they are given to you at this point in time, whether the valuation is good, bad, should you or should you not. The dependency is more on valuation. But when you talk about NFOs got nothing to do with the past, nor is there a visibility of the future, right? So NFOs and IPOs are not directly comparable like that in any sense. But I have a very simple understanding on NFOs. I think I would not want to invest in any NFO which does not offer something new which is not currently available in the market. What I mean by that is, let's say if somebody is coming out with a large cap fund, now why do I want to invest in that large cap NFO when I have a history of 45 funds that I look back on, and I can understand how have they performed in various market cycles, right? Or I have at least 20 funds with 20 years of history. Then why do I want to invest in a new large cap NFO which does not solve any problem which is currently not solved? So for me, I would only want to look at NFOs which are solving problems which are currently not solved by the existing fund ecosystem. Otherwise, NFOs are useless, at least the way I look at it.
Right, Ketan. Before I go to sort of one question, so too many AMCs are getting registered. So, how you see more players coming to this space? Would that be a benefit for the investors community, or as we saw in the past, there would be consolidation down the line, and some will close and some will merge, kind of thing can happen.
Look, today, if you look at it in the US, there are 10,000 schemes live at the time that you and I are talking. India is at 1,500, right? So it gives more options, right? But it also complicates life to a certain extent, because I'll tell you, uh, you would generally hear a lot of people who've been around tell you that more competition makes it the best for the investor community, right? But today, the only benefit that newer funds that can come in, that can bring on table, is reduce cost, right? So the more the number of funds come in, if they really want to compete, they'll have to come at a lower cost. But in my opinion, costs have gone down significantly, that at some point in time, room to lower down the cost will never become a USP anymore, right? And I don't think we are far from that in any sense. So if lower cost is not going to be a USP, what is going to be a USP for the newer AMCs coming in? The only USP is going to be how differentiated your fund is versus somebody else. So I am just very excited that the newer guys who are coming on board bring some differentiation versus somebody else, because if everybody is going to come out with an index fund tracking Nifty or an index fund tracking mid cap 250, I don't think that's solving any problem, and it is not going to add any value to the entire ecosystem. More and more people can come in, but that's not solving any problem.
राइट। तो वाजपेयी जी, आपको भी कोई सवाल हो तो आप पूछ सकते हैं। और मीनवाइल शिफाली, डू यू हैव एनी क्वेश्चन और बाय मिस्टेक यू सेंड द रिक्वेस्ट?
नहीं, ठीक है प्रिंस जी, अब इनकी बात सुन ली काफी। मेरा कोई क्वेश्चन म्यूचुअल फंड के संबंध में ऐसा ऐसा नहीं है। लिसनर्स में हमारे जो लोग हैं, अगर वो लोग चाहें तो वो लोग पूछें अपना। शेफाली जी है ना? शेफाली जी, आप
I think she's on mute. Never mind. Maybe by mistake she has sent. So, Kirtan, one more thing. Like some of the mistakes you already covered. Any more mistakes coming to your mind, which the people while investing in mutual funds often do, and surely can benefit if you can elaborate on that.
Oh, 100%, 100%. I don't think that most of us here, irrespective of the quantum of the money that we are investing, that can be 10 lakhs or 10 crores, need more than 4 5 equity schemes and 2 3 fixed income schemes. If any of y'all hearing me here have a list of more than 6 7 schemes, you are definitely not doing the right thing. You better recalibrate what your thought process is, because each of these schemes have 50 60 stocks that they've invested in. The reason why you are expecting these schemes to do better than the index is because you are assuming that the fund manager is selecting which 2025 stocks they find interesting versus buying the entire index, and that's how they beat the index. But if you are going to stay invested in 20 schemes, 25 schemes, you are invariably going to buy everything in the market, and you will never be able to uh, uh, get a better risk adjusted return. So you don't need, first learning is you don't need more than 5, 6, 7 schemes, and if you have more than that, you definitely need to sit back and reanalyze your thought process. Second is, don't look at the last 3 years of returns and invest, because the day you start looking at the last 3 years of return and investing, you are going to build a very concentrated portfolio. Because let's say if in the last 3 years value style of investing has worked, everything that you will select is going to be value style. Let's say if the last 3 years mid and small has worked, everything that you will select will be mid and small. Please don't look at the last 3 years of return and invest. I think these are, and of course don't invest in NFOs.
So, going by the contra bets, what has not performed in the past, and betting on that, and after the cycle turns, maybe in line with the interest rate or broadly the liquidity position in the market. So, would that also be a great strategy, provided the person is capable enough to gauge the broader
Oh,
market?
absolutely. Absolutely. I think the easiest way to make money in this market is contra. Now, what do I mean? Let's say in the last 1 or 2 years or last 18 months, large cap has not worked, right? So, this is actually the right time with a 3 year of time horizon to invest in large caps. You were asking me about sector investing. In fact, the easiest way to invest in sectors is look at the worst performing sectors in the last 3 years, 5 years, and bet your money there. Because when the cycle turns, when which generally does, you will see that the same sector will do well over the coming 3, 4 years. So the best way to invest in this market is taking contra bet with a 3 year, 5 year view, and most of the times you will end up doing a good job for yourself.
And one more thing, Kirtan, like when coming to stocks, individual stocks, anybody can sell. But coming to mutual funds, like often people struggle how they go about selling and how they can, I mean, part sell or sell completely. Any sense around like what should be not the best, but an ideal way for selling?
No, that will, Prince, that will depend on the reason why you want to sell. So I'll tell you, this is rather a very interesting question. Because let's say, for example, if I have a bunch of 30 funds that I've invested in, and let's say now I've understood that I only need to invest in 5, 6 funds, right? And now I want to cut down on the remaining 25. Now, if your question is that, what do I look at? How do I decide? Do I really want to get out? Should I get out of those 25? I think it's always going to be a difficult call. If you really ask me, I'm somebody who believes that if you are at 30 schemes, you've understood that you've made a mistake and you only want to stay invested in 5, you should just get rid of those 25 immediately at a blink of an eye. And I'll tell you why. Most people don't do this because they think, oh, if I exit, there is going to be a tax angle. I will have to pay capital gains, and there are so many of these other discussions that come around which are not great in my opinion, and I'll explain to you why. And I've done enough and more portfolio analysis to tell you this data point, that when you want to exit those 25 funds, right, you might feel that there is a capital gains tax that you have to pay, but largely that capital gains tax will end up being 1 or 2% of your overall portfolio, right? And I've done multiple portfolio analysis, and largely it turns out to be the same number of 1 or 2% is the tax. So the tax that, let's say if the tax that comes to you payable is 10 lakh rupees, but please understand that 10 lakh rupees of tax is on a portfolio of 5 crore to 7 crore. So the impact cost on your entire portfolio is 1 or 2%, even if the absolute amount is 10 lakhs. But unless you don't do this, right, and pay that 1 or 2% of your portfolio as tax and just get out of it, you are actually going to underperform by more than 1%, 2%, 3%, 4%, 5%, depending on how your composition of the fund is, continuously as long as you hold. So the call that you have to make is, do you really want to bite the bullet once and just pay off 1 or 2% of your entire portfolio as tax and align your portfolio together, or you want to continuously keep underperforming or taking higher risk or not making better risk adjusted return for another 10 years, year after year? I think it makes sense to just cut your losses once and for all, and align your portfolio together and bite the bullet once.
Fair points, Kirtan. I agree on those. So, Akshay, you can unmute and ask your question.
Okay, am I audible?
Yes, loud and clear.
Yeah. So my question for Kirtan is, so if I want to, let's say, have a asset allocation of, let's say, 80/20, so which debt fund I can use to have that 20% allocation in the debt fund side, and can I consider a corporate bond fund?
So let's say if you are, I'm assuming you are aggressive because you are saying 80% equity and 20% fixed income.
Mhm.
Really, if you ask me, that 20% fixed income has to be divided into 10% into credit funds and 10% into medium duration funds, and I'll tell you why. Look, Franklin, that happened was one of the case, right? Do
Mhm.
not extrapolate. Looking at the Franklin example, saying that credit is worst. The simplest way for you to look at fixed income, what works when, is whenever interest rates are topping out, like it is the current situation. You want to invest new money, invest money in medium duration and long duration funds, because when rates will fall, those funds will give you very interesting capital gains. But the reverse is also true. Let's say interest rates have bottomed out, and now interest rates are going to go up from here. Now, what do you do then? If you stay invested at the lower end of the curve, you don't make any returns. You hardly make any returns because transition of rates is not very easy in India. You will typically see, if you look at the historical data points, that when interest rates were extremely low, right, from there, that point onwards to another 24 months is actually the credit risk funds which have done well. So if you want a well diversified portfolio, right, where there is some part of your portfolio that is working in any given cycle, then your 10% has to be credit and 10% has to be medium or long duration fund. That's how I have bifurcated my 20% in the fixed income side.
All right, all right. Any name, if it is possible for you to give for those funds category?
Hey, uh, Akshay, sorry, I would not
No problem.
really be able to take the names.
No
My
problem. No
apologies.
problem.
I hope you understand. Yeah.
Yeah, yeah, absolutely. Thank you very much, Kirtan. Thank you.
Thanks. Thanks.
Uh, so I mean, risk, although you covered pretty well in our talk so far. Okay, Parth has one question. Let's go to that, then I'll talk to them. Yeah, Parth.
Thanks, Prince. Hi, Kirtan. Good evening. Uh,
Hey, hi.
Kirtan, I think you spoke really well on contra investing. I had a point intuitively. I invest in direct equities. Some of my friends who are regulatorily not allowed to invest in direct equities have suggested them to invest in index funds, which seem to be a really nice way to invest. I think what I have spoken to them is probably keep on investing in indexes which are doing well over a longer term horizon, probably 10-year, 5-year, 3-year, 1 year, 6 month, 1 month kind of a return ranking. And the aim would be to then capture performance which can then be have like a decadal outperformance. So to give you a brief idea of how I would be thinking is a Nasdaq 100 index fund did really well over the last 10 years, right? So if you're doing an SIP month on month, investing in the funds which are or indexes which are doing really well over 10 years, would you not then have higher allocations to that would be performing really well over longer horizons?
Sorry, I missed when you said higher allocations to what?
To fund. So let's take an example of a
Yeah.
person who's doing SIP every month to an index or a fund, which is the best performing or index or the fund when you're ranking them across time horizons. So when I'm saying across time horizons, I'm ranking indexes or funds from 1 year, from 1 month to 10 year, right? The return performances as opposed to other funds and indexes.
So Parth, I have a very interesting answer to your question. This will only work in a very self-disciplined investor and somebody who understands investing, and I'll tell you why. I'm not sure how long are you on the call, but I've repeatedly spoken about how markets work in cycle, and there are some times where value will work, there are some where growth will work, and some where momentum will work. And which is why you should have all three in the portfolio. My problem with having a complete full index portfolio is that you are selecting one style, which is momentum. In my opinion, index is a momentum play. If you have all your money in the index funds, you've actually let go of value style of investing and growth style of investing, and you've put all your 100% money in momentum. Why is index momentum? You see, what index does is very simple. Whichever stocks are performing are added, whichever stocks don't perform are kicked out of the index, which is why you see Adani also getting added, and good which have been good got kicked out of the index. So I think when you do index investing, you are only following one style of investing, which is growth, and it might significantly underperform over the next in the intermediary period over the next 10 years. So if you are a sophisticated investor and you understand this, that these 3 years it has underperformed because index is largely momentum, you this strategy is good, that you keep investing regularly for 10 years. But if you are somebody who's going to be questioning your investment thesis, saying that why is my fund not doing well when the entire market is doing well, right? Then doing everything in one style of investing, even if that is index and even if that is for 10 years, may not work for you, because your behavior will not allow you to stay invested.
Super. I think you hit the nail on the head when you say that it's a momentum style of investing. But when I'm saying index funds, I'm not just saying index funds. I'm probably saying sectorial ETFs as well. So surprisingly, the ETF that has the highest allocation in this particular style of investing is the CPSC ETF. So
Correct.
so so I think you have enough exposure to value per se when you're
Correct.
investing in this format. But I think superbly answered.
Hey, thanks, Parth.
Thanks, Parth, for your questions. So, Ketan, broadly, we have taken questions from speakers, and all the questions which came to my mind, I had asked. But again, anything which you had in your mind and you are yet to ask, you want to say in the concluding part of the session?
No, Prince. I think I've thanks to the kind of question that you and the audience have asked. I think largely whatever I really wanted to discuss, I have. But I still want to leave everybody with a thought that adding more mutual funds to your existing schemes is not diversification; it is concentration. Do not make this mistake. You don't need more than 4 or 5 schemes in your portfolio. I think that's the larger takeaway I really want everybody to have.
And two more important aspect, Ketan. One is like often we listen, I mean, hear of the two funds or maybe more than two funds have an overlap of common stocks. So how one can like take care of that? And one question after this, I'll take.
Yeah, so there are a lot of these websites available, Prince, that allow you to see what is the overlap between two funds. But like I said, if you follow my strategy, which was large cap, mid cap, small cap, and value and growth, if you diversify your portfolio and get 4 or 5 funds together which follow this theme, you've already taken care of the overlap problem by doing this. And which is exactly the reason why I don't think you need more than 4 or 5 funds in your portfolio. But if you want to check your overlap, there are multiple websites available. Anybody can just Google and they will get free access to a lot of portals which allow you to check the overlaps within schemes.
And on the part of ELSS tax saver funds, so what's the reasonable expectations, and is it a better instrument for those who want to save tax?
Oh, 100%. I mean, I have absolutely no doubt about why an ELSS is a far superior fund. And because I feel that ELSS, largely from an industry standpoint, is a large cap oriented fund. So if you see out of the 80% that is there in equity, 70% of that is large cap, broader category. Your expectation should not be more than 12% on that particular fund. But undoubtedly, in my opinion, that's the best way for you to save ATC, provided you understand that that is equity. A lot of us make a mistake of comparing it with a PPF or a 5-year FD or some other instrument. You can't do that's not an apple to apple comparison, because ELSS is equity and PPF is fixed income, right? So there is no apple to apple like that. But I think the best part of ELSS is, of course, in the long term, you can get 12%. The lock in is only 3 years, unlike most other products which have a 5-year, 10-year, 15-year kind of lock in. So I think I am very clear in my thought that whatever I have to do for my ATC, that is done through ELSS.
And one quick last question, Kirtan. Say if we are talking of ELSS tax saver funds, and there are a number of AMCs which are into it. So how to pick and choose which one is a better one for you? How you do that?
Can you repeat the question, Prince? Sorry, you broke up.
So basically, if we are able to identify the category, right? So then which
Hmm.
I mean, say for the likes of say, obviously no recommendation by something, but whether to choose a HDFC fund or ICCI or per se PP Fast or any other. I mean, how to make that segregation?
Okay, so if I have to sum up what I've been saying since the start, you will have to first break down your understanding about what funds are offering what style of investing. So if I'm saying value, you know it is ICICI HDFC. When I say momentum, you know it is Edelweiss Quant. When I say growth, let's say you know it is Access. Let's say for example. So you know that you need one of each of those funds because that follows the style of investing. I think even if you are able to do just this much, 90% of your work is done to bring the right AMCs together in the portfolio. Now, if you want to deep dive into what you want to do, I think I'm very clear that you want to take large cap exposure, you either do index or you either do flexi cap. And in mid cap and small cap, like I told you, active makes a lot of sense. But from a retail standpoint, now I have to tell you there are 21 different parameters that I look at before shortlisting. That if there are 40 large cap funds, which fund do I really want to invest in? Now I look at 21 different data points. I'm not sure if I'll be able to communicate how and what should you really look at, but I think the easiest way to do this is look at something called as a down capture ratio. You look at down capture and you look at something called as Sortino ratio. What is down capture? Down capture tells you that when the markets were falling, did your scheme fall less than the market, and you want funds which fall less than what the market falls. And you look at something called a Sortino ratio, which also says that when the markets were falling, how much return, risk adjusted return that your fund generated versus the index or the category when the markets were falling. So if you really ask me, my style is risk management. I really look at eliminating funds, and I look at funds which protect the downside, and that's my style. And hence, for me, down capture and Sortino are two ratios that you should really look at before onboarding a scheme. Once you've identified which is value, which is momentum, which is growth, you've identified large, mid, small, and now you want to go down granular in selecting the fund. I am somebody who will look at down capture and Sortino. Of course, I look at 21 data points, so just don't look at these two and identify what do you really want to do. But because I had to answer to your question, I think these are two important data points to look at.
Really helpful, Kirtan. And so, any places where I mean, we can find good content to learn about the nuances of mutual fund, barring a few books in the market.
Uh, I think the best way to learn about mutual funds is to read the fact sheets. Most of us, in spite of being in this industry, also don't read fact sheets. The easiest way for you to learn about mutual funds, about the scheme, about the styles of investing, is the mutual fund fact sheet. Because imagine if there are 5 funds in your portfolio and you read those fact sheets of those 5 funds month after month, after a year you will become such a pro on that. You know what the fund manager is buying, selling. You know how the fund manager is doing the sector rotations. You will understand what the fund manager thesis is versus the market macro. I don't think there is anything better than reading the fact sheet month after month. You might not understand it today, but 12 months later, while you've read 12 fact sheets of the 5 funds that you've invested in, you will know the significance of what and how that has really improved your understanding about investing in mutual funds.
Great. So, thank you so much, Keertan, for taking out time for this great session today. It was a pleasure listening to the nuances of mutual fund. Really helped our audience, and I hope we did justice to their time. And surely look forward to many more sessions as and when time allows us to share your thoughts. Thank you
Prince,
so
thank you.
much.
Prince, thank you so much for having me. I'm just hoping that it was worth for everybody who stayed on the call with us and heard me. I hope I made sense. Thanks so much for having me.
Thank you, buddy. I mean, we have a great audience because the festivity around and even the World Cup season is going on, and
Yeah.
still many people keeping and listening to these insight is a testimony that they are very much into markets and they love to hear thoughts of the practitioners in the market. Thank you so much. Thanks everyone. Have a great festival time, and surely you will compound your wealth if you work on the nuances we discuss in our spaces, and you must also be getting it platforms also. So Ketan, you are doing a wonderful job, and your tweets and the knowledge you share over your handle is indeed very helpful. I always check out your tweets, and those are greatly helpful for us. And those who are connecting for the first time can surely get in touch with Kirtan through his social media handle, and surely you will cherish that. Thanks, Kirtan.
Thanks so much. Thanks, friends. Thanks, everybody. Thanks for taking the time out.